Adani Wilmar stock has jumped 25% in last 5 trading sessions and has been doing great with few upper circuits to count in last week. But let's skip the stock news for now and try to understand the edible oil business in India. Indian edible oil market reached a volume of 22.3 million tons in 2021. Looking forward, the management of Adani Wilmar expects the market size to reach 26.3 million tons by 2027, exhibiting a CAGR of 3% during the period of 2022 to 2027. Another encouraging sign is that since people are more aware today, there is a large mind space for healthy food and nutritional supplements directed to preventive health care. We also see that edible oil companies are focusing more on the right combination that promotes heart health. Saffola, Fortune, and many more brands are focusing on presenting them as healthy for heart. India's per capita edible oil consumption of 19 kg per annum is comparatively lower than the global average of 24 kg per annum. Growing population and rising per capita consumption are expected to influence the demand growth. So all these factors are encouraging for the edible oil business. But as Yogi Berra once said about a famous Miami Beach restaurant, it's so popular nobody goes there anymore. If you ask me why am I quoting this now, it's because when an industry gets too popular, nobody makes money there anymore. The edible oil business in India is big, but the companies in this business are also in big numbers. A few of them are Saffola by Marico, Ruchi Soya by Patanjali, Healthy and Tasty by Imami, Dhara, Gemini, Sundrop, and so on. Further, the big daddy Reliance has announced that it's entering into FMCG business, which includes edible oil business as well. The competition is intense, with zero switching cost for consumers like me and you. In that sense, how can a business like Adani Wilmar, whose operating profit margins hover around 3%, can be valued at a PE of 116? Adani Wilmar revenue contribution goes like this: 84% from edible oil, 4.7% from food and FMCG, and 11.3% from industry essentials. Clearly, the edible oil segment dominates the top line, and that's a reason why the operating margin is just 3%. I don't see any reason why Adani Wilmar has to enjoy the high valuations like other top FMCG businesses like HUL, Nestle, Britannia, or Marico, whose operating profits always stay above 20% comfortably and deliver very high profitability ratios. For Adani Wilmar to enjoy such a high valuation, it has to quickly reduce the dependency on the edible oil business by aggressively pumping money into its food and FMCG business, which will increase the profit margins. But to do that, they have to fight against the best in the business like HUL, Nestle, and ITC, and with its closest competitor Marico, whose brand Saffola takes head-on with Adani's fortune. Let's check the facts. Company has very low margins with high dependency on edible oil business, which is just going to grow at a CAGR of 3%. And as we know, there is no pricing power in edible oil business. And also in recent times, edible oil business has been highly regulated. It has below average profitability ratios compared to FMCG peers. This makes Adani Wilmar very highly overvalued, even if the company doubles its sales, which is impossible considering its market share and size. Let's just try thinking about it. So let's consider sales doubles and margins remain the same, and the stock price remains the same as well. Even with these assumptions, the PE will stay above 60. To conclude with Peter's principle 16 from Beating the Street, in business, competition is never as healthy as total domination. So thank you so much for watching this video. Do press the like button if you did enjoy it.